This segment is going to discuss the use of the straight line method for calculating depreciation. The accounting for property, plant, and equipment involves three areas. The first is the cost for the asset when it is purchased. That was discussed in a prior video. This video is going to discuss how to allocate that cost across all periods benefited, which is the calculation of depreciation expense. Depreciation is really the process of allocating the cost of a plant asset to an expense in the accounting periods that benefit from its use. When we purchase the asset, it is recorded as original acquisition cost, and this amount is reported at the end of the period as the asset's value on the balance sheet. That asset cost, or value of the asset to the company, is allocated as an expense over the accounting periods that the asset is used to generate revenues. To calculate depreciation expense, we need to know three items. The first is the asset's original cost, what its expected salvage value, sometimes called the residual value, which represents how much the asset will be worth to the company at the end of its life. We also need to know the estimated useful life. There are three methods that can be used to calculate that depreciation expense: the straight line method, the units of production method, and the declining balance method. Regardless of which of these methods that is used, the adjusting entry recorded at the end of every accounting period to record depreciation will always be a debit to depreciation expense and a credit to accumulated depreciation. Depreciation expense is an expense account. It has a debit balance. Accumulated depreciation is a contra asset account. It has a credit balance. This account is tied to its related asset account. So if we were to look at the reporting of assets on the balance sheet, we would see the assets reported at its original cost, or the original price that was paid to purchase or acquire those assets. We would then see the balance in the accumulated depreciation account, the contra account, reported right along with the asset account. Contra accounts have the opposite balance, so they offset the account they're tied to. The original cost of $575 for these long-term assets show that of the original value to the company, $122,000 of the cost has been used up and recorded as an expense. The net amount, or the book value, or the value that these assets still have to the company in future accounting periods, is $453,000. They originally paid $575 for them, but they have used up and expensed $122,000 of the assets' value, leaving the assets with a current book value of $453,000. So using the straight line method, ABC Company had purchased equipment at a cost of $50,000. So when they purchased that equipment, they recorded an asset, equipment, for $50,000. The estimated useful life is 5 years, and the estimated salvage value is $5,000. The depreciation method to calculate the expense for the year will be to take the original cost minus its salvage value and divide by useful life. Cost of $50,000 minus the salvage value of $5,000 divided by a 5-year useful life. This company estimates that $9,000 of the asset's cost needs to be expensed. The journal entry will be a debit to depreciation expense for $9,000 and a credit to accumulated depreciation for $9,000. What we'll see is at the end of that first year of the asset's life, we will have recorded a $9,000 depreciation expense, bringing the balance in accumulated depreciation up to $9,000. The balance in the accumulated depreciation is offsetting the original asset of $50,000, bringing the asset's book value down to $41,000. At the end of the second year, to calculate year two's depreciation expense, we would have to record the same journal entry. Under the straight line method, we do not need to recalculate depreciation expense for year two because it is going to be the same amount every year. The asset's cost is still $50,000. Its salvage value is still $5,000. Its estimated total useful life is still 5 years. That means even if we were to recalculate year two depreciation, we would end up with the same amount. The journal entry would look the same at the end of year two as well. So year two's depreciation expense would be a debit of $9,000, crediting accumulated depreciation for $9,000, causing the balance in accumulated depreciation to increase to $18,000, causing the book value of the asset, which is the asset's cost, less its accumulated depreciation, will come down to $32,000. Year three's depreciation would be exactly the same. Under the straight line method, depreciation is the same amount year after year after year throughout the asset's life. So what we're seeing is every year under the straight line method, it is a straight and even amount of $9,000. With each year's depreciation expense journal entry recorded, the balance in accumulated depreciation continues to rise. The reported book value of the asset declines over its life. This is true because as the asset's cost is used up, the value of the asset is decreasing to the company. When we get to the last year of the asset's life, we can see that the asset has a book value of $5,000. Even though we're at the end of the asset's life, it's still worth $5,000 to the company because they can sell it or salvage it. It has a residual value of $5,000.